All right, what's going on, everybody, and welcome to another episode in my series on technical analysis. Today, the topic of the video is triangle patterns. As we're going to see in this video, there's a lot of different triangle patterns that act in different ways. The first thing you need to know about triangle patterns is that the lines have to connect at the apex or the cradle. Next up is that the distance between the first high reversal point and the first low reversal point within the triangle is called the base. And the final thing you need to know, which works for every single of the triangle patterns, is that breakouts usually happen before the end of the pattern. And there you go. So the first pattern we're going to look at is the descending triangle. This is a continuation or a reversal pattern, meaning that once it breaks out, you don't know if it's going to be to the up or to the downside. These patterns are very reliable, especially if you have high volume on the breakout. Reliable meaning that once it breaks out, it does so with a lot of strength. Then we also have the ascending triangle, which is exactly the same thing. It's a continuation or reversal pattern, meaning that it can go either to the up or to the downside on the breakout. The next type of triangle is the symmetrical triangle. Once again, a continuation or a reversal pattern. Compared to the previous two patterns that I talked about, the symmetrical triangle produces very strong breakouts, but the thing is that you don't know in what direction it's going to break out. The way you can look at it is kind of like a coil. You have prices swinging from a low to a high, to a higher low, to a lower high, and the prices are converging to a single point. But the way you could see it is like if it's a coil, it's building up pressure before exploding into one direction or the other. Statistically speaking, this is a very profitable pattern. The following pattern is called the Megaphone Top, or otherwise known as the broadening triangle formation. This is not a very good pattern to trade because it has a very poor profit potential. Why? Because when we see the breakout, it's occurring already at a high or a very low point after an already very big price run. And the way you could think about megaphone tops is that it's like the price is swinging up and down with increasing volatility, and thus it is more and more out of control. In this case, the breakout is not a very meaningful moment nor a very profitable trade. And so in the next lecture, we're going to be talking about wedges. But before we move on to that, I just want to add an extra little pattern that's not a triangle, strictly speaking, but you can kind of see it as a combination of two symmetrical triangles. And it's called the diamond top formation. This is usually a reversal pattern, which can be seen as such. This pattern is quite rare, but when it happens, it's a very profitable pattern. So that pretty much wraps up the video. Thank you so much for watching. I'll see you in the next one. Peace.